Alright guys, so today we are going to talk about chapter 5, which is cash flow statements. Alright, so why do we need cash flow statements? Alright, cash flow statements tell us if there are like inflows or outflows of cash within like the cash flow or within the company itself. Alright, so what does inflow mean? Inflow means money coming in to your company. So you are probably selling something. So if you're, let's say, your assets go down, which means you're selling your assets. It means you're getting money, so you're getting inflows for your company. There are inflows in your cash flow statement. But if they go up, you are gaining assets, but which means you're losing cash because you're buying the assets, which means it's cash outflow. All right, so there are about, I think, 3 types of cash flows that we're going to learn about in this chapter. All right? Okay, so the first one we're going to learn about is cash flow from operating activities. All right, so we call CFO. So how do you calculate that? To calculate CFO, you need net income from the income statement. You add the depreciation expenses, then you subtract the change in operating assets, and then you're gonna add back the change in operating liabilities. So what are operating assets? Operating assets are accounts receivable and inventories. But okay, then what are operating liabilities? That's accounts payable and accruals. All right. So, but you also have to remember that depreciation expense is a non-cash expense. All right. So that's the first one. All right. The second one that we're going to learn today is called cash flow from investing activities. So we call CFI. How do you calculate CFI? All right. So it's 0 minus change in gross fixed assets. All right, gross fixed assets is not always given to you. So how do you calculate that? Gross fixed assets is usually calculated by getting the change in net fixed assets plus depreciation. Where do you get that depreciation? It comes from the income statement. All right. So that is the second one, and now we will move on to the third one. All right, the third and final one is going to be called cash flow from financing activities. So CFF. All right, so bear with me. This one is a bit longer than the other two. For the equation is kind of a bit longer. All right, so how do you calculate that? All right, you're gonna do the change in notes payable plus the change in the current portion of long-term debts plus the change in long-term debts. So you're going to get the current long-term debts and the long-term debts, the change in both. All right, and then you're going to add, again, you're going to add the common stock. Also, you're going to subtract the dividends payout. All right, so how do you calculate dividends payout? This is usually given by subtracting the change in retained earnings, all right, from the net income, and that is how you get the dividend payout. And that is the end of chapter 5. Actually, that's not the end. One last thing. There are other stuff I didn't really explain all in details, but I didn't because we're running out of time, and this video is supposed to be 5 minutes. But that's pretty much the overall of this chapter, so you can understand exactly what we're doing. All right, thank you.